Hello and welcome to the Fall 2023 Special Needs Financial Planning Webinar Series Kickoff. On behalf of the Johnson Cotroneo Group and Moores & Cabot Investments, thank you for participating in our presentation today. My name is Brian Cotroneo, and I wear a lot of hats at the Johnson Cotroneo Group. One I am particularly proud of is the CHSNC, Chartered Special Needs Consultant. The CHSNC is the financial industry designation for professionals trained in the techniques and nuances of financial planning for individuals with special needs and their families. It's these techniques and nuances I'm very happy I get to share with you today. As a reminder, this presentation is being offered 4 times during the month of October and is also being recorded for those individuals unable to attend live. For those of you watching in real time, we will have a question and answer session at the end of this presentation. If you're watching a recording, we encourage you to visit our website at www.floridaspecialneedsplanning.com or reach out directly with questions using the contact information at the end of the presentation. Now that that's out of the way, let's get started. I've always found it helpful to lay down a roadmap for presentations like this, so we'll start with a brief outline of our discussion topics. The first thing we're going to address are some very common misconceptions related to special needs planning. Following that, and to make sure everyone's on the same page, we'll define what special needs planning is and why it's necessary. Afterwards, I'll do a brief overview of government benefit programs and how they relate to special needs planning. We'll then discuss the tools and resources that special needs planning relies upon, who takes on what roles and responsibilities, and then a detailed review of the planning process itself. Finally, we'll address the way forward for an individual or family who has decided they need special needs financial planning but isn't quite sure where to start. Now let's dive in. Planning for individuals and families with special needs is challenging for a host of reasons, but one that we see most frequently are misconceptions that come with supporting a member of the special needs community. On the screen here are statements that we've heard firsthand from caregivers. Each of these statements presents a problem for an individual or the family supporting the individual with special needs. Some of them aren't true, and others don't have to be if we don't want them to be. But the fact of the matter remains, there are no shortcuts to special needs financial planning. You simply have to do the work. In this case, the old axiom is definitely true. Failing to plan does mean planning to fail. Now, we have used the phrase special needs planning or special needs financial planning at least a half dozen times so far during this presentation, and we're only a few minutes in. So it makes sense before we go any further to make sure everyone has the same understanding of what special needs planning is. We'll get into the specifics of the process and the different roles and responsibilities shortly, but at its core, special needs planning boils down to a single sentence. I promise this is one of the only times I will read directly off of a slide today, but it's important that we get this right. To put it simply, special needs planning is a process to assure an adult with a physical, cognitive, or mental impairment a place in the community appropriate to his or her needs, capabilities, financial resources, and wishes for the nature and quality of their own life. So that definition is a mouthful, but it's meant to be that way. It's incredibly dense because it's supposed to convey just how important special needs financial planning is. This isn't something that you do over the course of a day or a night or a weekend. It's not something that's a flight of fancy. It is a process that you have to go through, and you have to go through it intentionally. Now, we can break down that definition to make it a little bit more digestible. And that's really what we've done with this next slide, where we start talking about what do we try to accomplish with special needs planning versus what do we try to avoid with special needs planning. So you can see here what we've done is we've broken down into trying to accomplish and trying to avoid. Now, trying to accomplish is pretty straightforward. We're looking to assure a quality of life above the bare minimum standard set by the government. We will see this in later slides when we get to government benefits, but the key word when it comes to assistance from the government is poverty. The government's objective is to provide for individuals at the poverty line and no higher. Our objective is much more ambitious, as shown in our next bullet point, and that's to provide security, independence, dignity, and the ability to pursue personal interests. To put it more succinctly, it's the ability to have a real quality of life. When it comes to the things we're trying to avoid, well, that first bullet point is simply the forfeiting of all those things that we just discussed. right? If we're living a lower than desired quality of life, it means we don't have the security, independence, dignity, and ability that we desire. That second bullet point is a particular one of particular interest, and that's disqualification for government benefits. While the goal of the government is to support an individual at the poverty line, many times the support it does provide becomes the foundation that other resources can build upon. If we lose that foundation, then the entire construct crumbles. So ultimately, while the government might only provide a certain meager level of support, that support is still critical. Um, Third, when we look at, we want to avoid exhausting financial resources. Frankly, this is the same consideration that everyone has, which is not to run out of money. The difference is here, the individual with special needs doesn't have the same opportunity to re-enter the workforce, to restart income, or in some cases to even earn income at all if their plan takes a wrong turn. And finally, not accomplishing broader family financial goals. While typically requiring more attention, the financial planning for an individual with special needs is still only a part of a family's holistic financial plan. It's incumbent upon us as planners and advisors to find a way to facilitate the needs of the individual with special needs without jeopardizing the goals of the other family members, things such as retirement, higher education, and philanthropic legacy. So we know what special needs planning is, we know what we're trying to accomplish, and we know what we're trying to avoid. The next logical question is, why is special needs planning necessary? Why wouldn't a simple family financial plan help someone come to the same conclusion? Well, the answer to that is because of the complexity and the assumptions that are involved inside of the special needs planning process. Every special needs situation is different, and it requires its own assumptions. If you look at the first bulleted list, which is not exhaustive, it highlights some of the more obvious differences from one situation to another. Everything from an individual's specific capabilities to the support available from the family and the government. Those are going to change in every case. There are no rules of thumb to drive how a special needs plan needs to be built. All of those assumptions are then going to be used to create estimates around what the cost of raising or supporting an individual is going to look like. And those differences have led to a range of expectations for those values. Shown in the second set of bullets are the estimates for the lifetime cost of support. And as you can see, they range from $960,000, according to the U.S. Department of Agriculture, to almost $3 million, according to an independent women's financial organization. Again, the individual circumstances will dictate where in that spectrum you and your loved one fall, but that variance, 960,000 to 2.8 million, is a massive variance to get your arms around without proper planning. The next point is something that really puts the difficulties of any do-it-yourself mentality on display. In most personal finance cases, there are rules of thumb that individuals rely upon to make decisions. I'm not necessarily saying these approaches are correct. In most cases, in my experience, they aren't, because they're broad and based on the law of large numbers, not individual circumstances. But people do use them to get an approximation of their needs and required performance. Fortunately or unfortunately, these guidelines, and I'm using that term loosely, don't even exist for special needs planning, as I mentioned previously. Because of the massive difference between the low end and the high end of cost estimates, trying to find that average amount needed to fund an acceptable lifestyle could leave an individual hundreds of thousands, if not millions of dollars short at the end of the day. When it comes to government benefits, you've already heard me say this, but we will address it explicitly in bold, underline, and italic font on this slide. Government benefits are a tremendous help if an individual with special needs qualifies for them. However, they can also complicate the situation immeasurably because it is government policy to support a person with a disability at the poverty line. If you have the means to support yourself beyond the poverty line, the government would rather you do that on your own, and then they will send the money elsewhere. For this reason, they impose income and asset limitations on certain benefits to make them quote unquote means tested. Put simply, you have to be poor or appear poor to qualify for them. This can make providing support, both financial and physical, a challenge for families who do have some resources but not enough to provide everything needed without some government assistance. The last, but by no means least important reason why special needs planning is necessary is to ensure that broader family financial goals remain attainable while still providing for the individual with special needs. When we look at the cost for decades of care, therapy, residential services, etc., it is very easy to get overwhelmed. All too frequently, we see parents and grandparents allowing those needs to push out all the other aspirations that they have. Retirement, education, legacy, these are more commonplace, but equally important financial goals that can still be realized with a proper plan. Planning also provides a framework to discuss issues that will impact siblings of the individual with special needs, should they have any, things like guardianship, financial support, and long-term residential arrangements. The next section we're going to discuss is government benefits, but before we do, I wanted to make a quick clarification on some of the statements we've made about government benefits. You've heard me say multiple times that the government exists to support an individual at the poverty line. And we know that under certain circumstances, that statement might sound negative or harsh. We don't intend it to be. We know as special needs financial planners that a lot of our clients can only attain the quality of life they aspire to because the government is providing some base layer of support. However, what we want to make sure we guard against is that common misconception. If you think back to the first slide of the presentation, the very first quote was, "The government will take care of my child once they turn 18. We know from experience that while the government will provide some support, it is usually never enough to be considered being taken care of. If we think about providing the bare minimum as advisors to special needs families, as special needs family members ourselves, we don't want anyone that we work with or anyone that we care about to be subject to the bare minimum. And that's why we keep bringing it up. That's why we want to make sure that the point is understood. So as we move into this discussion of government benefits, we're going to acknowledge the advantages and the positive that come from them. Just always keep in mind that it is never a complete solution. Government benefits are simultaneously the greatest source of funding and financial resources for special needs families, but also the greatest source of headache and frustration. One of the complicating factors of government benefits is there are multiple types, and you or your family might qualify for one or both, those types being entitlement or financial need. Entitlement benefits are those benefits you or your child are eligible for because you paid an employment-related tax. Simply put, this is the benefit you derive from years of paying into programs like Social Security and Medicare. Financial needs programs are means-tested programs that are developed to care for the poor. When we discuss government policy being the support of the individual at the poverty level, these are the programs designed to do that. Supplemental security income, commonly referred to as SSI, and Medicaid. The two main entitlement programs that special needs families can qualify for are Social Security and Medicare. Please know that there are other programs, many administered on the state level, that may also be available. For the purposes of our overview today, we're going to stick with these two. Social Security benefits are provided to individuals who meet the Social Security Administration's definition of a disability, which is an individual who must not be able to engage in any substantial gainful activity, abbreviated SGA, because of a medically determinable physical or mental impairment that is either expected to result in death or has lasted or is expected to last for a continuous period of at least 12 months. SGA is a number that changes every year and is indexed to inflation. In 2023, that number is $1,470 per month. In order to receive Social Security benefits, one of two things must be true. The individual themselves must have paid Social Security taxes for a minimum number of work credits, currently 40 credits with each credit equaling 1/4 of full-time work, or the individual must be the child of an eligible individual who is currently receiving Social Security retirement or disability benefits themselves. Important to note is that payments are a function of earnings history and will not be consistent from person to person. The more an individual or their parent paid into the program, the more they can expect to receive out of it. Medicare benefits are less complex, but no less difficult to attain. To qualify for Medicare, a person under the age of 65 must have received Social Security disability income payments for 24 consecutive months. Alternatively, the individual can be categorized as an adult disabled since childhood if their diagnosis predates their 22nd birthday, in which case they can qualify for Medicare based on their parents' earnings record. Similar to the entitlement programs, there are two primary programs on the financial needs-based front to discuss: Supplemental Security Income, SSI, and Medicaid. SSI is an income program for the poor to provide resources at the poverty level. Similar to the SGA definition, this is a monthly amount indexed to inflation. In 2023, that amount is $914. However, there is a catch. In order to qualify for SSI, a person cannot have more than $2,000, which is known as an asset limitation. Additionally, any income the individual makes outside of the SSI payment can potentially reduce the SSI payment itself. This is what's known as the income limitation. For a minor, parents' assets are deemed to be available to the minor until he or she reaches the age of 18, making it incredibly difficult for any children to qualify for SSI. With regards to Medicaid, Medicaid is what's known as the insurer of last resort for the poor, elderly, and disabled in the U.S. It's also the primary provider of long-term care in nursing, assisted living, and cognitive impairment facilities. Medicaid can be used to supplement private insurance if an individual has it, but it is also subject to asset limitations. In some cases, again, as low as $2,000, similar to the SSI limitation. There are estate planning tools used to work around these limitations and their associated look-back periods, but they're beyond the scope of our discussion today. In most states, an individual who has qualified for SSI automatically qualifies for Medicaid, which is one of the primary benefits of applying as early as possible for SSI. Now that we've gotten government benefits out of the way, we're going to dive into the real meat and potatoes of special needs financial planning. We're going to start with a quick discussion of the different tools and resources we have at our disposal as planners, and then actually go into the roles and responsibilities inside of a financial plan, as well as the actual special needs financial planning process. The first and likely most impactful tool we will discuss is a special needs trust. Special needs trusts are a planning vehicle that provides individuals with special needs access to financial resources without disqualifying them for government benefits. If you think back to our previous discussions regarding government benefits, we know that in order to receive financial aid, or at least some portions of financial aid, the individual needs to have the appearance of being below the poverty line by not owning or earning substantial assets. This is where a special needs trust comes in. Special needs trusts are separate legal entities, and thus assets held in trust are not deemed to be the property of the individual, even if the trust has been set up to provide support to the individual as the beneficiary. There are two types of special needs trusts to consider. A first party, which hold assets that are already owned by the individual, such as legal settlements or inheritances prior to the trust's formation, and third party trusts, which hold assets not already in possession of the individual, such as insurance proceeds or gifts made after the trust formation. The main difference is that first-party trusts are subject to what's called a Medicaid repayment. Third-party trusts are not. Special needs trusts can hold an unlimited amount of assets and are not limited just to investable assets. They can also hold real assets such as homes and other property. Special needs trusts can also provide for contingent beneficiaries in the event that the individual with special needs has siblings or children who could make use of excess funds after the individual's passing. The next account that we're going to go over is a 529 ABLE account. And ABLE stands for Achieving a Better Life Experience. That's exactly what the accounts were built for when they were created by Congress a few years ago. Simply put, an ABLE is a savings and investment account for an individual with a disability. It can hold up to $100,000 worth of investable assets, a number that is not indexed to inflation and does not increase every year, that do not count, again, towards benefit eligibility. An ABLE account can be funded by any one or multiple contributors up to $17,000 per year, again, a number that in this case is indexed to inflation. And additional contributions can also be made by the individual with special needs themselves, up to the poverty level amount of $14,580 in 2023. Funds from a designated beneficiary qualified tuition plan, otherwise known as a typical 529 account, may be rolled over into a 529 ABLE. Distributions from the account must be used to pay for a qualified disability expense, or QDE. And QDEs include but are not limited to housing, transportation, education, technology, health and wellness, legal and financial services, and employment training. The final tool to go over for now is guardianship. And guardianship is a process, it's a legal process that is undergone when a person loses or gives up some of their civil rights to another person to be carried out on their behalf. Generally speaking, this is a process that is handled almost exclusively by attorneys. And I can't stress enough that questions of guardianship should be addressed with an attorney knowledgeable in the matter before the individual reaches the age of majority, age 18. In pretty much every case, once an individual turns 18, the process of attaining guardianship, even if it is in their best interest, becomes significantly more complicated. So what we're going to get into now are the roles and responsibilities associated with a special needs financial plan. If you look at the diagram on the right, we've put the special needs individual in the center of two circles, which we have very creatively named the inner circle and the outer circle. The inner circle represents individuals that the special needs person has a direct relationship with. This might be a member of their support group, like parents or extended families. This might be a teacher, a therapist, or a doctor. The relationship is personal with these people. And so that's not where we live as financial planners, as investment advisors. We live out on the second circle, the outer circle. And our job really is to support not just the individual with special needs, but in some cases, provide support for the inner circle, for parents or extended family, or to provide resources that allow the individual to continue to work with therapists and doctors. That outer circle really is made up mostly of financial professionals of various degrees. And it's important to note that some of them are going to be around for a little bit of time, and some of them are going to be around for a very long period of time. In fact, that's really the easiest way to categorize that outer circle is by the tenure of that individual with the special needs financial plan. So if we break down the outer circle, right, we're going to see we start with temporary and transactional relationships. Now, these are going to be individuals who are brought in to achieve a certain milestone or complete a certain product. In the case of a Social Security specialist, this is the person who's filing and seeking approval for government benefit programs like SSI, SSDI, Medicaid, and Medicare. As soon as those benefit programs are attained, that individual then moves on. The second individual is going to be an incredibly important individual in the process, and this is going to be a competent estate attorney, preferably someone with special needs backgrounds. This individual is going to create the estate vehicles and the documents necessary to execute the financial plan. So we have trusts, wills, and power of attorney listed, but this is also the individual who's going to build the special needs trust structure if one is deemed necessary. The second category is going to be long-term advisory relationships. So this is where we at Johnson Cotroneo Group live, and these are individuals who are responsible for doing a job really for in perpetuity, where the job doesn't strictly end. As a financial planner, that job is to build, monitor, and maintain a special needs plan. Special needs plans are something that are incredibly intense up front, but they're constantly evolving and they're always dynamic. The situation is fluid and changing. So the plan needs to be fluid and the plan needs to change. And that's really the job of the planner, is not just to build it, but then to make sure that it can be flexible enough to adapt to changing circumstances. The investment advisor, which is also a hat that we wear, this is the individual that manages the investment accounts for the person with special needs. While the plan is going to show exactly how many resources are necessary to achieve a certain quality of life, it's the investment advisor and the advisory work that actually generates those resources by investing assets, by locating assets in certain areas. The third individual in the long-term advisor relationships is going to be an accountant. This is going to be an individual who handles trust accounting requirements and tax filings. And while that might feel more like a transactional relationship, it might be in any one given year, but if you find a really good accountant who knows about special needs, you're not going to want them to go away. So that's going to be somebody that you're going to continue to go back to year after year. The day-to-day caretaking relationships are ones that are much more intense in terms of their activity with the individual family, although it might not necessarily be with the individual themselves. The trustee is going to be the individual that approves distributions from accounts and supervises other team members. What we typically see for younger individuals with special needs is that parents or siblings will usually take on the trustee role. And then in many cases, they will hire a contingent trustee from a company, from a trust company. And that's typically referred to as a corporate trustee. A trust protector is somebody who's going to amend the trust as necessary, and this is the person who's supervising the trustee, especially if it is a corporate trustee. So the trustee is going to supervise other team members. The trust protector is going to supervise the trustee. And then the final individual is going to be a guardian or conservator. This is the person who makes decisions regarding the person and the property of that person if they're not capable of doing it themselves. Now, it's important to note that while some of these individuals might be involved in the special needs plan for a short period of time and others in perpetuity, there are some cases where not all of them might be necessary. If an individual with special needs already possesses such a copious amount of financial resources that they're never going to qualify for a government benefit program, well, then a Social Security specialist isn't strictly necessary because we're not going to apply for benefit programs we know we don't qualify for. So please don't view this list as a list of purely necessary individuals, but these are the most common groups of professionals that are involved in executing a special needs financial plan. So up to this point, we've discussed what special needs planning is, what we're trying to achieve, what we're trying to avoid, who is it that does it, what is their job, what are their tools and resources that they use, and what are the government benefits that we lean on in order to accomplish it. What we haven't discussed is the process, but that's what we're going to do right now. What we don't want you to take away from the following few slides is that this is a how-to manual to try and do this yourselves. And we're not just saying that because this is what we do for a living. We're saying that because this is really a very general overview of what the process looks like. But we found that over time that it's incredibly important for people to understand what the process entails so that they can understand what it is that they're getting themselves into. So please think about the next couple slides as we walk through the process, not so much as an instruction manual, but instead more of an introduction to how it is we do what we do with special needs planning. Similarly to how we started the presentation with a roadmap, we're also going to start the process discussion by laying out all of the steps that are inside of the process. Now, as you can see in front of you, the process itself has 9 different steps. I'm not going to list them all to you right now because we're about to go over them in slightly more detail. But what we found is that it's helpful for people to understand that a process does exist. It has a finite number of steps. It is linear. And ultimately, the goal is for us to use this to become proactive in addressing whatever issues could arise for the individual with special needs and their families, as opposed to simply being reactive and trying to respond instinctively when something happens that we didn't anticipate. Now, the first step in special needs financial planning is actually the construction of a family financial plan. If you think back a couple slides, I mentioned that the special needs financial plan is really just a piece of a holistic family plan. And logically, that makes sense. If we were to only build a special needs financial plan, then we would only be taking into consideration the needs of one individual inside of the family. Not only is that not fair, it's just simply illogical, right? Because the actions and the needs of those other family members are going to impact the individual with special needs. So when we build a family financial plan, what we're doing is we're addressing all the issues that are independent of special needs. We're looking at things like retirement planning, education planning, legacy planning, ultimately all of those things that you're going to deal with from now throughout the rest of your life that are associated with your finances. The reason why we do that is because that family financial plan is the foundation of the special needs plan. Each variable of the special needs plan is going to have an impact on the family financial plan. And in turn, the special needs plan is going to be impacted by whatever occurs inside of the family's foundational plan. So the two are very symbiotic, and you can't really have one without the other. Ultimately, though, the main takeaway for families with this is that building the family financial plan and the special needs plan independently of each other to start, and then connecting them allows us to answer very, very typical questions that special needs families have. Questions like, how does saving for a lifetime of care change your desired retirement age? I can't tell you how many parents I have in our first conversation. They say, well, I know that I can't retire because my child with special needs is going to require me to work for the rest of my life. That's not always true. In fact, in most cases, it is not true. But we can't answer those questions if we don't have the full background into both the family and the individual. The second step in building a special needs financial plan is to write a life plan and a letter of intent. Now, these two documents are qualitative support documents. They don't include numbers. We're not talking about dollar amounts here. The goal for these two documents is that you, as the caretaker or the individual with special needs, if they're able, is to describe their life and living circumstances long term. Ultimately, this is an aspirational document. While grounded in reality, we want to hear from you or the individual themselves what are their preferences with regards to where they live, who they interact with, what job they have, if they're capable of having one, anything and everything that might impact the quantitative side of developing a financial plan. It is important that these documents be written with an unvarnished eye, in that the expected capabilities and limitations of the individual should be accurately represented. There is some tendency on the part of individuals to be a little bit more unrealistic in terms of their description of what a future state might look like. Ultimately, these are documents that are going to help us guide our expense estimates, our cost estimates. What is life going to look like? And so realistic assessments are incredibly important. It's also incredibly important to include an in case of emergency instruction if primary caretakers become unable to provide consistent care. Ultimately, what this is going to do is it's going to give us a fallback if the individual that is currently driving the process from the family side is no longer able to do so. The third step in the process is going to be to calculate lifetime cost of care. And this is really where the most amount of number crunching happens with respect to building the actual plan itself. As I mentioned during step 2, it was important for the qualitative documents for the life plan and the letter of intent to be grounded in reality. And that's because we're going to use that intent and the desire expressed in those letters to identify the costs of the individual's anticipated lifestyle. To put it very simply, you're going to tell us what you want the individual's life to look like, and we're going to figure out how much it's going to cost. Costs are going to have to be phased in and out of the plan as necessary. Obviously, what an individual requires when they're 5 or 6 years old is not going to be the same thing they require when they're 50 or 60 years old. And we also have to adjust all those costs according to inflation and any other factors that might influence them. When we talk about the types of costs we're going to consider, the list is quite literally limitless. But at this point, the most commonly considered expenses include all of those things in the table there. Everything from rent and mortgage to respite care, personal assistance, day programs, etc. The fourth step, after we've determined what the total cost of care is going to be, is to determine the government benefit eligibility. As we described earlier, government benefits really make up the base of the financial resources that the average individual with special needs can expect to tap over the course of their life. So we're going to start with entitlement programs. And if a minor child is eligible for survivor or dependent benefits, that's going to be one of the first questions we ask. If the individual is an adult, we're going to look at whether or not they have met the SSA's definition of a disability, and therefore they meet the SSDI requirements. We're also going to look at whether or not parents or guardians of the individual are currently receiving their retirement or disability benefits, which is going to be the trigger for them to potentially receive them as well. On a financial need perspective, if the individual is a minor, we're going to look at the family's assets. Do they have income or assets that are above the means test amount and therefore are disqualified from benefits like SSI or Medicaid? If the individual is an adult, does the individual have income or assets above the means test amount? If the answer to that is yes, then at that point we also start looking at other vehicles to go into things like estate planning, which we'll discuss in a couple steps. If an individual is not currently qualified, and most individuals are not when they start this process, and that's okay, can we expect the individual to meet the qualification criteria? And if so, when? Step 5 is going to be to calculate the funding gap. And when we talk about the funding gap, what we mean is the dollar value of care over the individual's lifetime that is not going to be paid for by government benefit programs. Generally speaking, it's found by taking the total cost of lifetime care and subtracting the government benefits that we expect to receive. I would say that this is the single most important number when it comes to building a special needs financial plan, but I can't say that because there are two sets of results that are required. The first is an annual number, and then the second is what's referred to as an aggregate number. The annual number is a set of numbers. This is the cost to provide care for any given year. So every single year is going to have a funding gap number. Each year will have a different cost due to inflation and the addition or removal of individual expenses. The aggregate number is going to be the cost to provide care for the entirety of the individual's lifetime if the funds were placed in an account today and conservatively invested. Both of these results are crucial. The annual number shows what has to be available if financial support is continuous as planned. So parents continue to work and provide a portion of their income to the individual with special needs. The individual with special needs themselves is capable of continually working and helping contribute to their own care, etc. The aggregate shows what must be available if financial support ceases abruptly. So this is the case of a untimely passing of the individual who was primarily responsible for providing financial support to the individual with special needs, or if the individual with special needs has a situation that develops where they can no longer work and can no longer contribute to their own financial well-being. So both of these numbers are incredibly important because both of them have to go into the financial plan and both of them need to be solved for. The sixth step is going to be to assess the resources that are available to the individual. Now, resources available to the individual are going to include any financial instruments that are either first, currently listed in the individual's name, or two, have the individual or individual's trust listed as the beneficiary. So when we're talking about what types of assets, we're looking at personal resources. Those are checking and savings account, education accounts, right? 529s, UTMA or UGMA accounts if the individual is a minor child, or retirement and investment accounts, usually if they're an adult. When we're discussing familial resources, we're only going to look at insurance policies if the individual or their trust is already a listed beneficiary, or any inheritances that have already been put into a irrevocable state. So because of the nature of some of these transfers and because some of the tax implications and because some of the means testing, we only want to be looking at familial resources up to this point if the assets are 100% definitely going to flow to the individual. The seventh step is going to be estate planning, and this is where we establish the proper estate planning structures in order to ensure that money flows to the right location when it is needed. Now, I mentioned in the previous slide, we want to be careful about making sure we're only taking into account assets that are going to be heading towards the individual on an irrevocable basis. That's because if we can find a better or more optimal way for them to flow to the individual, or even better, to a trust that the individual is a named beneficiary on, we can eliminate some complications with government benefits and taxes. So the types of estate planning vehicles we're going to look at special needs trusts, whether it's first party or third party, depending upon who owns the assets currently. We're going to look at a family trust, which can direct assets into the special needs trust upon a caretaker passing, but doesn't require assets to be put into the special needs trust immediately. We're going to look at a 529 account. So specifically the ABLE account, make sure we're getting those tax advantage savings up to $100,000. And we're also going to update retirement accounts and insurance policy beneficiary designations so that transfers that could potentially violate the income or asset ceilings for government benefits don't happen. This is critically important. There have been a number of both academic and professional articles written about individuals who go and they spend a lot of time and a lot of money to get their estate plan looking perfect with numerous trusts set up, only to forget to update the beneficiaries on one of their insurance policies and negate all of that work. Step 8 is titled Create a Funding Plan, but it could just as easily be titled Where Does the Money Come From? Very few special needs trust and 529 ABLE accounts are fully funded when they're opened. In fact, most of them are not. Families will typically go to an estate attorney, have them structure a special needs trust for them, and then open up an account for the trust with a very minimal deposit, something on the order of $20 or $100. This amount allows for the account to be opened and to stay open, but doesn't actually tie up any financial resources with the trust. It just allows for the trust to exist and be available in the future when it's needed. When it comes to creating the actual funding plan, our best practice uses a two-part funding strategy, the base case and the worst case. The base case builds upon a basic assumption of life expectancy for both the individual and the caretakers, which is a fancy way of saying nobody is going to pass away early. In the base case, we're going to utilize things like annual income, savings, and investment growth to fund lifetime expenses. Because we're typically dealing with years and in most cases decades for funds to grow, we don't have to worry about putting large amounts away right now. We just have to worry about putting the right amount away consistently over the course of a certain number of years. The worst case, however, works quite differently. In that case, we're assuming that income from caretakers is not available because of untimely death or disability. In that case, we won't have income, savings, and investment growth to rely on, nor will we have a significant time period that allows the money we do have to compound. Instead, what we have to utilize are insurance policies and inheritances to fund lifetime expenses by obtaining a significant amount of money now that we can put away and allow it to grow and then ultimately draw upon over the years. Our final step is manage, monitor, and adjust. The creation of the special needs plan is a huge milestone, and completing it is a lot of work. In most cases, it takes weeks, in some cases a few months, in order to actually go from first meeting to the completion of the special needs financial plan. But at the end of the day, completing the plan really just is the beginning of the process that extends for the rest of the individual's life. When it comes to managing, whether we're talking about monthly deposits or large lump sums, funds need to be managed in order to optimize the risk and return relationship. Because we're talking about such large time frames, in some cases decades or close to the entire life expectancy of an individual, we can't have too much risk inside of a portfolio. And while it's true that everyone's risk return profile is different and needs to be dependent upon things like their age, their tolerance, etc., we do know that at the outset, special needs plans have some degree of challenge because they don't invest similarly to the way that an individual would. When it comes to monitoring, most assumptions in the plan are dynamic and will change annually, if not more frequently. Think back to what we've talked about for government benefits and the annual or monthly earnings limitations, or when we talk about the contribution limits on a 529 ABLE. All of those numbers change every year. And so monitoring the plan for changes in things like those numbers, but also for things like inflation increases, market fluctuations, and changes in the legislative and regulatory landscape are crucial. The final point of step 9 is to adjust, and that means when changes do occur and the plan is impacted, when that probability of success goes from a high number to a lower number, we want to make adjustments that get the number back up. And we do that by altering the investment mix, changing what's in the portfolio, altering the savings level, putting more money away than we originally had planned for, or shifting timelines, maybe delaying retirement by a year for an individual who's the primary caretaker of the individual with special needs. Step 8 is titled Create a Funding Plan, but it could just as easily be titled Where Does the Money Come From? Because this is the step where we're going to talk about how much do we save, where do we invest, and how do we find a way to develop enough resources to close the funding gap and afford our cost of care. Now, a lot of people assume when they open up a special needs trust or a 529 ABLE account that it needs to be funded completely. That is not the case. In fact, very rarely does that happen inside the United States. In most cases, what families will do is they will open up a trust, they will open up an account, and then they will fund it with a bare minimum requirement, usually $20 or $100, whatever the bank who has the account requires. The plan then becomes to build resources over time inside of that account instead of just have the funds sit there stagnant, unavailable for other uses. In our experience, the best practice is to use a two-part funding strategy, what we call base case and worst case. Base case utilizes the assumptions of life expectancy for the individual and for their caretakers that are government average. It doesn't assume anybody's going to pass away anytime soon. As a result, we're able to utilize income, savings, and the growth in compound interest inside of investment accounts to fund lifetime expenses. Time, in the base case, really is our ally. In the worst case, it develops quite differently. In that case, we assume that income from caretakers is not available due to untimely death or disability. Effectively, all of that annual income, the periodic savings, and the time that we were depending on to let investment accounts grow goes away. Instead, we have to utilize lump sum payments that can be available now, usually through insurance or inheritance, to fund lifetime expenses. Once we have a funding plan in place, our last step becomes manage, monitor, and adjust. Now, the creation of the plan is a major milestone, and it does represent the completion of a lot of work. In most cases, a full plan will take weeks, if not months, to build from the date we first meet with a client until the date we have something actionable. But a completed plan is still just the beginning of a process that extends for the rest of the individual's life. When it comes to managing, it doesn't matter whether we're talking about monthly deposits or large lump sums. Whatever funds are in the investment accounts have to be managed, and they have to be managed appropriately. When we say appropriately, what we mean is there needs to be a balance between the desired return on the investments and the amount of risk that we're taking. We also have to monitor the actual plan for any changes. Most assumptions that we put into the plan are dynamic and are going to change frequently, at a bare minimum annually. If you think back to the slides regarding government benefits and the contribution limits on 529 ABLE accounts, all of those numbers about means testing and how much you can make in any given month, those are all indexed to inflation for the most part, and they all adjust every year. And so there needs to be adjustments throughout the plan every year in order to mirror those changes. We're also going to look at the probability of success for the plan as it relates to forces outside of just those types of limits. We're going to look at the success against things like inflation increases, recent market fluctuations, and any changes in the legislative or regulatory landscape that might have evolved over the course of the last couple months or years. Once we get through the monitoring phase, once we get through the managing phase, we're then going to look at the adjusting phase. We know what's changed. Now, how do we react to it? And in fact, at that point, we know that the plan has been impacted, and so we have to counter those impacts, usually by altering our investment mix, changing our savings levels, or in some cases, shifting timelines for either the individual with special needs or the family who's providing the support for them. All right, we've done it. We have reached the final slide before we get to disclosures and contact information, and that's exactly what you would think it'd be. It's our roadmap forward. What is our next step? Where do we go from here? Hopefully, over the course of the presentation, you've gotten a lot of useful information. We've talked about what planning is, why it's necessary, what does the process look like, what are the tools. But what we haven't talked about is how do you know whether or not this is right for you personally, your situation? Ultimately, that is a question that you have to ask yourself, and it's a determination that only you can make. Can we help? Absolutely. We have 2 questions we recommend all caregivers or even individuals with special needs ask themselves about whether or not they need special needs financial planning. The first question is, do you already have the financial resources necessary to provide lifetime care? Remember, if we go all the way back to the beginning of the presentation, lifetime care can be estimated to cost anywhere from $1 million to $3 million, in a lot of cases even more than that. So do you have that readily available and not earmarked for any other purpose? Can you just put that aside and say that is going to be used for that individual's care? If you don't, it's probably a good idea to look at how you go about procuring that. The second question is, do you have the knowledge, interest, and time to manage this process personally? It's not knowledge, interest, or time. It's knowledge, interest, and time, because all 3 of those are necessary. Now, if you're saying there's no way I could have the knowledge, interest, and time to manage this process personally, that would be a full-time job. You're absolutely correct. It's our full-time job. We don't expect individuals with special needs or their support people to have that. That's why we're here. That's why we do what we do. The second step, if you answer both of those questions and you say, yeah, it is necessary, I do want special needs financial planning, is to engage with a special needs financial planner. Find someone with personal and professional experience in this specialization. And I mean that within this specialization. Special needs financial planning is an incredibly esoteric niche. Most planners don't go anywhere near it. Most trust companies don't deal with it. A lot of attorneys don't go anywhere near it. And so you need to find somebody who has experience, who has the credentials, who's worked with these types of clients before. Also understand that this is an investment of money, time, and trust. If you think back to when we talked about the different roles and responsibilities, financial advisors and financial planners and investment advisors, those are 2 groups of people that are going to work with you in perpetuity. We're not creating a plan and then leaving you to your own advices. We're going to be there step by step to help you make sure that the plan reaches the point of fruition. And so you have to create trust. There has to be a bond. There has to be a relationship. Also, you can start the family financial planning process. You don't have to create your own family financial plan, but start asking yourselves those questions that we discussed. When do you want to retire? What do you want it to look like? What are the education plans that I have for my children? What type of legacy do I want to leave? That way, when you do sit down with a financial planner, it's not the first time you're contemplating those questions. Third step would be write a life plan and a letter of intent for the individual with special needs. It's part of our process, but these things don't have to be done only as part of our process. In fact, these are guiding documents from which a lot of decisions can be made independent of special needs financial planning. As planners, we can facilitate the conversation around those points, but we can't answer the questions for you because we don't know the individual with special needs as well as you do. And so, really, those are questions only you can answer. If you don't know where to start, if you want to write a life plan, but you don't even know how to structure it, please feel free to reach out to us. We have free templates that we're more than happy to give out to you. They can guide you through and even help ask you some questions that help you get to the right answers. Last step, speak with family members. Ensure that the best intentions don't create challenges. This is something I like to refer to as the grandparent problem. Case in point, you have an individual with special needs who have grandparents that have a lot of financial resources. The parents don't talk to the grandparents about money issues. They don't talk about necessarily the individual with special needs diagnoses and their limitations. And so when the grandparents pass, they leave a large amount of money to the individual with special needs, thinking that they're helping. And while that money obviously can help, if they leave it directly to the individual, they might lose benefit eligibility, and now they end up in a worse spot than they would have been if they hadn't even inherited the money. Things like that, you don't have to give full details, but it always helps to start having conversations and setting expectations for who inside the family is going to do what and how people are going to help. Ultimately, this is another role that if things get too uncomfortable or they seem to be too complicated, you can always feel free to tap us on the shoulder. We're more than happy to facilitate those conversations as part of our planning engagement. And with that, we've reached the end of our presentation. Thanks again for participating with us today. We really enjoyed having you. I'm going to go ahead and put up our last slide, which is our disclosures and our contact information for about a minute or two. And then if you're watching live, we're going to roll immediately into the question and answer period. So feel free to hang out for about another minute, and then we'll go ahead and get that started. If you are watching a recording, please take down the information on our contact us slide and go ahead and refer any questions to us through our website. Again, that's www.floridaspecialneedsplanning.com. Our email is also on there, as well as our phone number. You can feel free to reach out to us directly if that's easiest. Thanks again. We hope to hear from you soon.